Greetings of the day for all of you who are listening to this video. Today, in this session, um, I am sharing with you all one of the income statement of one of the firm, that is Hero Motor Cycle, Hero Motor Corp. See, when you take up any income statement or balance sheet, any annual report of any company, if you pick up one component in the annual report or the balance sheet or any one component in the annual report itself, it won't you won't be doing a fair job while determining the financial health of the company. Just with one component alone, one item alone from this statement, it won't be easy or it won't be fair enough to predict the financial performance of the company. We will not be knowing whether the firm is growing, whether the firm is stable, or the firm is deteriorating. Or and on the other hand, if you want to pick up more of the items, like you may pick up profits, you may pick up sales, you may also pick up the EPS. When you pick up lot of parameters to know whether the firm is growing, stagnant, or deteriorating, then in that case there might be lot of conflicting decisions that may come up. For example, the sales might be the revenues, or this revenues from the sales might be going up, but your profits might be reducing, or your EPS might be less comparatively. So again, looking at three or four parameters might give you conflicting thoughts. So your decision becomes very complicated. In such a situation, there are a lot of models that are available for us to determine the financial performance of the company. That is, to know whether the firm is growing over the years, or whether there is a decline in the growth compared to the previous year, or whether there is no growth but they are trying to maintain at the same level, that is they are stable, or whether they are performing better compared to the peers. So to know this, we have lot of models. From among the models, we consider one model as the best model, and that is the DuPont model. And one thing I want to highlight over here, this DuPont model is 100-year-old model, and it has been used for several years. And till today, we consider this DuPont model as the best model to know whether the firm is growing, stagnant, or deteriorating. You can also use this DuPont model to compare the performance of the firm over the years with the past year's performance and also with the peers in the industry. And this DuPont model, as I told you, it's a 100-year-old model. This was um, developed by um, a salesperson from a company called as DuPont. There was a salesperson called as Donaldson Brown. He was working as a salesperson in a DuPont company. The company name was itself was a DuPont. But at that time, there was a crisis with that firm, and they were unable to identify why there was a decline in the growth of the firm. What was the reason that was causing for that decline? So it was a worry for all of them. So this is the time where Donaldson Brown developed a model called as DuPont model. He gave the name for this model as the name of the company itself. So he called it as DuPont model. And with the help of DuPont model, he tried to give one parameter called as ROE, that is return on equity, and how it is calculated. And just by knowing the return on equity of the firm, you will be able to analyze, you will be able to interpret and decide whether the firm is growing, or whether there is a decline in the growth, or whether the firm is at a stable position. And this model, it was developed in the year 1912, long back. But till 1920, this model was not taken that seriously. Though it was a success, and Donaldson Brown had applied this to his company, he was able to identify, they were able to identify what was the root cause for the decline in the growth of that firm, or for that improvement in the growth of the firm. They were able to identify, but people did not take it seriously at that time. in the year 1912 till 1920. But it was after 1920 this model became famous. People started applying this applying this formula, that is a model, and started to see how it is useful in analyzing the performance of the company. So through this session I'll be teaching you how to use this DuPont model and analyze the financial performance or the financial health of any firm. You can apply this model to any firm and you'll be able to tell whether the firm is growing or whether the firm is deteriorating or whether it is a stable firm. Okay, let's begin. I'll show you this DuPont model. This is the model I wanted to show you all. And I'm going to explain you how this model helps you in identifying why there is a increase in the growth or why there is a decrease in the growth or why there is a stability in the growth and what is a root cause for whatever it is for the change in the financial performance of the firm. So this DuPont model, as per this model, Donaldson Brown, he gave a formula or a model for identifying the financial performance. He said that just with this one parameter, that is a return on equity, you will be able to say whether the firm is growing, stable, or deteriorating. And in the end, this is what all of us want to know: whether the financial health of the firm, whether it is fine or whether it is not fine or whether it is maintaining. Okay. And as per the DuPont model, how we find return on equity is your profit after taxes divided by equity shareholders funds. Equity shareholders funds. So dividing the profits after taxes, we all know that profits after taxes are the profits which are available to equity shareholders. That is after you keep aside whatever is necessary, after you pay taxes, after you pay interest and all the other obligations, you take that profit after taxes, that is that portion of the profit which is available for equity shareholders, and divide that by the equity shareholders funds. And this, with this you will be able to calculate return on equity. Okay, and here, for example, let's take one hypothetical situation where the return on equity of a firm, of any, we'll take one firm, some firm, let's not name any firm. So let's compare the return on equity for 2 years of this firm. Assume that previous year the return on equity of the firm is 23% and this year it is 20%. So in the previous year the return on equity is 23% and this year it is 20%. So by this we can easily tell that the return on equity from the past year has reduced compared to the return on equity of the current year compared to your previous year has reduced. There is a reduction. Okay. So here we can clearly see that there is a decline in the growth. That is, return on equity has declined. There is a decrease. But what we are more interested is we want to know why there is a decline, why there is a reduction, what is the cause for this reduction. For this decline in the return on equity, what is the reason that we need to know. And as per this model, DuPont, as per the DuPont model, Donaldson Brown says that return on equity we calculate by taking PAT divided by equity shareholders funds. And also this return, how return on equity is arrived at. It depends on the profitability of the firm. It depends on how the assets are utilized, that is the efficiency, asset efficiency of the firm, and also it depends on the amount of risk the firm has taken. So these are the three elements which will contribute to the return on equity, that is profitability, efficiency of the assets, and the risk that is involved in the firm. So all these three things will contribute to the return on equity. How much profitable the firm is, how efficient the firm is in utilizing its asset, and how the firm is managing the risk. What is the amount of risk that that the firm has undertaken? So all these things will contribute to the um, return on equity. That is, these are the three elements which will influence your return on equity. Okay, so return on equity is calculated by multiplying profitability into efficiency and into risk. The product of profitability, efficiency, and risk will give you the return on equity. The combination of these three. Okay, now see, the decline in the return on equity can be because of profitability, or can be because of efficiency, or can be because of the risk factor in the firm, or can be because of the combination of any of these. So now here, as actually in the DuPont model, we are decomposing the profit on equity. That is, this one element can be decomposed into various elements, and by decomposing we'll get to know what is that actual root cause for the change in the return on equity. Here there is a decline. So what has caused to the decline in this return on equity? Is it because of profitability, or is it because of asset efficiency, or is it because of risk that is involved in the firm? Let's look into that. How is profitability calculated? To know the profitability, to calculate the profitability, we use the income statement. Income statement. That is, we get the information from the income statement to calculate the profitability. How do we calculate the profitability? Your profit after taxes divided by revenues. Okay. You all know, when I was explaining you about when we are looking at the annual report, especially when we are taking into account the income statement, we don't read the income statement as it is given. We rearrange the things that is given in the income statement in a specific order, which I have already showed you, to make our decision making much easier. So we get all this information when you arrange. It is easy for you to pick the information to calculate the profitability. And the profitability is calculated this way. That is, profit after taxes divided by revenues. So what does this mean? We know that profit after taxes is your bottom line and revenues is your top line. So you're dividing the bottom line by the top line to get the profitability. And this profit after taxes includes your interest payments, includes your taxes and all the other obligations which are to be paid. And here we'll see, we'll decompose this profit after taxes further. So before that, think that the profit after taxes, that is the profitability of the firm, last year it was 20%. Last year it was 20%, and this year it is 18%. So here, when we calculated profitability, we got to know that previous year the profitability was 20%, this year it is 18%. So we can see that there is a decline in profitability. So we can easily say that the decline in return on equity is because of decline in the profitability. And profitability alone might not have contributed. Along with profitability, even efficiency and risk might have contributed to this decline. But one thing we are sure here is that profitability is one among the factors which has contributed to the decline in the return on equity. Why there was a decline in profitability, that we will have to decompose further. To know why there is a decline in profitability, we will decompose this formula. The first element we'll take over here is PAT divided by PBT. That is, we try to compare how much is profit after taxes with how much was profit before taxes. So we are trying to study the proportion of profit after taxes in relation with the profit before taxes. This is one element we are decomposing from the profitability, so that we'll get to know what has caused to the decline in the profitability, which in turn has caused to the decline in return on equity. Then the next one is profit before taxes divided by profit before interest and taxes. So here we are trying to understand how much was the profit before taxes in comparison with profit before interest and taxes. And lastly, the third element we take into is we try to understand how much is profit before interest and taxes in relation with the revenues. So basically what we have done over here as part of these three elements is we have decomposed this formula. We have decomposed the profitability. That is, we have broken down the profitability into much simpler ones to know the actual reason for the decline in the profitability. See, looking at this, when you multiply these three, when you multiply profit after taxes by PBT into profit before taxes by PBIT into profit before interest and taxes by revenues, this PBT as you all can see gets cancelled out, and PBIT will get cancelled out. So in the end we have what we are left with is PAT divided by revenues, which is nothing but a profitability. So here basically what we are trying to do is we are decomposing this profitability formula to find out further what is the real cause for the decline or decrease in the profitability of the firm. Okay, now let's look into the first element under profitability. Profit after taxes divided by profit before taxes. Think that last year your profit after taxes in comparison with profit before taxes was 80%. So what does that mean? That means that 20% has gone for taxes. So your tax rate was, how much you paid tax? You paid tax of around 20% last year. Okay. And this year, the profit after taxes in comparison with profit before taxes is 75%. 75%. So easily we will get to know that your profit after taxes compared to the last year has decreased. Okay. And that means that here in the second year, your tax burden was 25%. So that means when you look into this element, you can easily get to know that tax has contributed to the decline in your profitability, which has in turn contributed to the decline in the return on equity. And to understand this better, see, tax rate in the previous year, it was around 20%, the amount of taxes you have paid in comparison. This year, there was an increase in the tax burden. As we all know, tax is something which is not in the hands of the organization, of any firm, because tax rates, as we all know, under tax laws and tax acts, it is not determined by any industry or firm as such. So, the tax factor is external to the organization. So, when it is uncontrollable, when it is not in the hands of the firm, then we cannot do anything. The firm cannot do anything. But there are times where internal factors might also increase the tax burden. If it is because of the tax rate by on account of tax laws or tax acts, then the company will not be able to do any changes or manage. But if the cause is because of the internal factors, for example, the company might not have paid previous year taxes, so in the present year their tax burden has increased. So there is a tax burden because of the internal factors. Internal factor is about mismanagement of taxes or not proper planning of the taxes. So when the company does not do proper planning of taxes or there is a mismanagement of taxes, usually they'll have to go through a lot of information. But if they miss out of one information or if they interpret the information given in the Income Tax Act in a different way, then they might end up paying huge taxes. So this tax may also contribute to the decline in the profitability, and how it can be corrected is proper planning. If the real cause is because of the internal factors. If the external factors, again the company will not be able to do anything much, will not be able to do much about this. So here we can easily get to know that tax is one factor which is contributing to the decline in profitability. Okay. Then next one, PBT in comparison with PBIT. Here the element or the difference that comes in between is your interest. interest on loan or interest on your debt capital, interest payment. Okay, here we'll talk more about this impact of interest payment on your return on equity when we are discussing about the risk element. Because this interest payment is directly connected to your capital structure, which has a debt capital. So there we will look into. So what here we can identify is that your tax factor and also your interest payment factor can have an influence on the profitability. That is, they can impact your profitability and also in turn impact your return on equity. Okay. And the last element which we take into account are PBIT by revenues. So PBIT by revenues is the most important thing we'll have to consider. So this is basically out of operations. The PBIT is fully is the result of operations of the firm. So out of the total, out of the actual operations of the firm, how we'll get to know how the operations of the firm, whether there is efficiency in the operations of the firm, whether there is an operational efficiency in the firm or not. And here, in case of PBIT by revenues, this is one major factor which can actually have a which will cause a drastic decline or drastic increase in the profitability is mainly caused by the operations than compared to the tax and interest payments. See, comparatively, operations, interest payment and tax, out of these three, tax and interest payments can influence your profitability not to a very large extent, very minimal, comparatively very minimal. They might not influence your profitability to a very large extent. The influencing factor which will contribute to your profitability is your operations. So this is very much important. And here, if there is a small difference from the last year, or if there is a small decline compared to the last year, whether it is 2% or 0.2%, it should be taken seriously, because this small decline in profitability out of operations might cause a big problem in declining the growth of the firm. This is where the firm has to be very careful about. Say tax payment, I'll reiterate again, your tax payment and your interest payment will not, they might cause the change in the profitability, but not to a very great extent, very minimal. They might contribute to very small portion, but your operations will contribute to the larger portion. It is a maximum. So much of the influence on the profitability is because of operations. So a small change in PBIT by revenues can cause a big change in return on equity, whether it can be positively or negatively. So any change in PBIT by revenues should not be ignored. It should be taken very seriously, and we can further decompose this to know the exact reason for a decline or for the growth in the PBIT by revenues.